As the FOMC meeting approaches, expectations are for the Federal Reserve to cut its benchmark rate to around 3.6% by year end, with three cuts projected for 2025 and gradual easing into 2026 and 2027. One major U.S. bank predicts five consecutive cuts, targeting a 3 to 3.25% range, driven by cooling inflation and a weakening labor market. However, dissent within the Fed is possible, with Governor Waller and Trump nominee Stephen Moran potentially advocating for a larger 50 basis point cut, while others may resist cuts due to recent inflation spikes, potentially marking the first meeting since 2019 with conflicting dissents. Such division could spark market volatility and speculation about inconsistent policy moves. Markets anticipate a rate cut, but a sell the fact scenario could lead to a temporary dollar rally and risk asset sell-off, though weak jobs data might sustain expectations for further cuts, keeping the dollar's broad downtrend intact. A European bank notes increased hedging of dollar exposure by foreign investors, likely amplifying dollar weakness as hedging costs drop during the Fed's easing cycle. Meanwhile, the Trump administration's push for lower rates, alongside moves like the Genius Act, signals concern over the U.S. fiscal situation, potentially aiming for a 3% inflation target under a new Fed chair, which could increase long-term dollar risks. On the data front, U.S. August retail sales are expected to rise slightly, reflecting resilient but cautious consumer spending. Other U.S. releases today include a slight decline in the import price index, stable export price index, flat industrial production, and a subdued NAHB housing market index, highlighting ongoing housing sector challenges due to high rates and weak demand. That's all for now.